All right, guys, so here we are picking up where we left off in the last video. We are now on to review example number 2. So take a second, maybe you have your paper right along with us, and you can now review and read through example number 2, right? So it says on the first day of the fiscal year, a company issues a 2.5 million, 4% 5-year bond that pays semi-annual interest of $50,000, receiving cash of 2.4 million. So what it's asking us to do is now journalize the entries to record the issuance of the bond, the first interest payment on June 30th, and the amortization of the related bond, and then last but not least, the payment of principal at maturity date of December 31st. Right, so there's a lot going on, but we got this. I am confident that we're gonna get it. We're gonna get it down, okay? All right, so the first part, as I mentioned in the last video, we need to make sure we understand if this bond will be sold at a premium, if it's going to be sold at a discount, or if it's going to be sold at the face amount. Okay, so which one is it? Question marks, right? All right, so first off, you need to know that there's no market rate of interest. So how are you going to figure out which one is which? How do you determine if it's sold at a discount or premium? Okay, so hopefully through reading this, you saw that the company issued it for $2.55 million, excuse me, but they only received cash of $2.4 million. So it didn't implicitly say that or explicitly say, hey, this was sold at a discount, but we can make the assumption that it was sold at a discount because we didn't receive the full amount of what we issued our bond for, right? If it had been, it would have been for maybe $2.5 million, right? But we received less, right? Less than what we wanted. So therefore, in the marketplace, there must have been a better interest rate. Therefore, we had to sell ours at a discount. All right. So it asks us to journalize the issuance of the bond. So on January 1st, I'm going to capture that. I'm going to capture cash in the amount of $2,400,000. Right? So let's right now just do the parts Maybe you're not as familiar with the accounts yet. But what I know is when I issue a bond, I have created a liability, and that's going to be my credit of $2,500,000. Okay. So now what goes between here is you need another debit to balance this transaction. And that debit is going to be the discount on bonds payable. And the difference between the two, or what I did not get when I issued this bond, was a total of $100,000. Okay. All right. So B asks us to journalize the first interest payment on June 30th. Okay. So this is what is going to my investors. So on June 30th, they have already told me how to calculate it or what it is. It's in my annual interest payment. So I'm going to do a debit to interest expense in the amount of $50,000, and then my credit is going to be to cash, okay, of $50,000. Right? All right, C asks us to amortize the related bond. So they're speaking of this discount, right? We didn't receive the full $100,000, and now we're going to amortize it over the life of the bond, which the life of the bond is 5 years. So we're going to take this $100,000, the amount of the discount, and divide it by the number of periods, right? So what is the number of periods? Well, the way we go about getting that is we take the 5-year bond, and we're going to amortize it twice a year, right? 2 times a year. And so our number of periods equals 10 periods. Okay, so that what goes here. And therefore, our amount, our amortized amount, we're going to do 100,000 divided by 10, and our amount is going to be 10,000, right? So this amount equals $10,000, right? So now let's capture that journal entry. So on June 30th as well, we're going to capture a journal entry of interest expense, interest expense in the amount of $10,000, and then my credit is going to be to the discount on bonds payable. Okay. And then, as we mentioned before, we can combine those two. I'll come back to that. I just want to work through the entire problem first. All right, D. D asks us to journalize the payment of principal at maturity. All right. So on December 31st, after the 5 years is up, my investors want their money back, right? You have loaned the money or kept the money for the 5 years. Now it's time to pay it back. So my journal entry to capture this is going to be to reduce my liability, which is my bonds payable of the in the amount of 2.4 million. So hopefully if you're reading through this, you should have been like, what? Girlfriend, that's wrong, because it is wrong. So even though you did not get the full amount that you wanted, even though you got $2.4 million, you must still repay the principal amount back. So therefore, your journal entry to journalize this is going to be bonds payable of $2.5 million. And then your credit is cash in the amount of $2.5 million. Okay. All right. All right. Last but not least that we need to capture is that I said I was going to come back to is I am going to now combine these two journal entries together, right? Because if you're using Cengage, they're not going to give you 4 lines to fill out this journal entry. They're going to expect you to combine them together. So that's exactly what we're going to do if my pen stays. All right. Anyways. All right. So the way we're going to do this, I'm going to slide this picture down. And all right. So here it is. I'm going to take my like terms. So on June 30th, I have interest expense as my debit, right? So I have an interest expense debit of 50,000 plus another interest expense of 10,000 debit. So both of those added together will give me 60,000. And now I'm going to fill in my credits, right? So these two are taken care of. And now I'm going to fill in cash and the discount. So you can do it either way. So it is going to be cash. Okay, cash in the amount of my credit is going to be 50,000, and then my other credit is going to be the discount on bonds payable in the amount of 10,000. Do we balance? Hopefully you said yes. Okay, so this is the combined transaction. So hopefully that makes sense to you. As always, you guys, if you need help or you're lost or you're like, girl, what? Let me know, and then I will try to help you out from there, okay?